Silver alert, $61 broken. The Fed has lost control. We are witnessing a historic fracture in the financial dam that the mainstream media is desperately trying to patch with duct tape. While the talking heads on CNBC are distracting you with tech stocks and political theater, something fundamental broke in the commodities markets today. Silver did not just move. It detonated, ripping through resistance levels like wet paper to touch $61 an ounce. This isn't a speculative bubble, my friends. This is the market screaming that the US dollar has lost its clothes. For over 20 years on Wall Street, I have watched the paper games, but what happened today is the signal we have been waiting for. Let's look at the raw numbers, because numbers don't lie, unlike the bureaucrats at the Federal Reserve. Silver exploded nearly 5% in a single session, smashing through the $60 psychological barrier to sit at $60.80. We are talking about an asset that is now outperforming gold by double digits, yet the average American has zero exposure to it in their 401k. This is the silent boom. The smart money is positioning itself while Main Street is still asleep at the wheel. We are seeing a divergence between reality and the paper promises of the central banks, and silver is leading the charge. You need to understand the magnitude of this move in the context of history. We aren't just flirting with new highs, we are shattering records that have stood for decades. The metal is up over 109% this year alone. Think about that. While your savings account is earning dust and losing purchasing power to inflation, real money, God's money, has doubled. This is what I call a wealth transfer event. The wealth is moving from those who hold paper currency, which can be printed into oblivion, to those who hold tangible assets that cannot be counterfeited by a printing press. Now, the naysayers and the paper pushers will tell you to be careful. They will say this is volatility, that it's risky. I find it ironic that Wall Street calls holding a physical asset risky, while they leverage derivatives at 100 to 1. But even amid this euphoria, I must be the voice of reason. Markets do not move in a straight line forever. We saw a massive surge today, but volatility cuts both ways. However, the trend is undeniable. The dam has broken and the water is rushing toward real assets. The question is not if silver goes higher, but how much purchasing power the dollar loses against it. Let's zoom out to the macro picture, because you cannot understand this silver move without understanding the rot at the core of the global financial system. The United States is drowning in debt, and the interest payments alone are becoming unmanageable. The Federal Reserve is cornered. They have two choices: let the system collapse under a deflationary depression or print the money to pay the bills. The market knows what they are going to do. The market is pricing in an 87% chance of a rate cut. They are preparing to loosen the noose, and that is rocket fuel for precious metals. This isn't just about interest rates, it is about faith. The entire fiat currency experiment relies on confidence. When you see silver moving with this kind of velocity, it is the canary in the coal mine gasping for air. It tells us that faith is eroding faster than the Fed can patch it up. The dollar index has dropped 8.5% this year. That is a massive move for a reserve currency. It's a slow-motion crash of the world's standard of value, and investors are fleeing the burning building. Silver is simply the fire exit that everyone is trying to squeeze through at once. We have to talk about the physical market, because that is where the real war is being fought. For years, the paper market on the COMEX has dictated the price, allowing bankers to suppress the true value of silver. But the physical market is tightening. We are seeing reports of supply deficits that are impossible to ignore. Chinese inventories are hovering at their lowest levels in over a decade. Think about the implications of that. The world's manufacturing engine, China, is running out of the very metal needed for electronics, solar panels, and batteries. This is a supply crunch of epic proportions. There was a historic squeeze in the London market back in October, and while the mainstream financial press said the concern had eased, the price action today tells a different story. You cannot print silver. You have to dig it out of the ground, refine it, and ship it. That takes time and capital, neither of which can be conjured up by a central banker. The supply chain issues are still weighing heavily on the market, creating a floor under the price. The paper shorts are getting nervous because they know that if push comes to shove, they cannot deliver the physical metal to cover their bets. Let's discuss the paper versus physical dynamic further. We saw a chaotic halt in the COMEX exchange in late November that dried out liquidity. They literally had to stop the game because it was getting out of hand. That outage needs a federal investigation, but don't hold your breath waiting for one. When the liquidity dries up and the paper games stop working, the true price discovery begins. We are seeing a decoupling. The paper price is trying to catch up to the physical reality, and that reality is that there isn't enough silver to go around at these suppressed prices. The industrial demand for silver is the sleeping giant that most investors overlook. Silver was recently added to the U.S. Geological Survey's list of critical minerals. This is an admission by the government that silver is vital for national security and the economy. They are terrified of running out. From cruise missiles to electric vehicles, silver is indispensable. This isn't just a monetary metal, it is a strategic asset. The fact that the government is flagging this now tells you everything you need to know. They are worried about securing supply, and you should be too. We also need to look at the gold-to-silver ratio, which is one of my favorite indicators for value. For a long time, this ratio was blown out, meaning silver was dirt cheap compared to gold. But now, it has narrowed significantly, dropping below 70 to sit around 69.35. When this ratio collapses, it usually means we are in the late stages of a massive bull run where silver plays catch-up and slingshots past gold. Silver is the high beta version of gold. It runs hotter, faster, and harder. We are seeing that play out in real time right now. Now I want to address the mainstream media's sudden interest. The Washington Post and Forbes are finally running headlines about silver smashing records. This is the magazine cover indicator. When the general public starts hearing about it, we are entering a new phase of the mania. But be careful. The media is usually the last to know and the first to give you bad advice. They are asking, what does this mean for the economy, expecting a soft landing. I'll tell you what it means. It means the economy is sick and silver is the fever breaking. The jobs data, the JOLTS report, was another catalyst today. Job openings rose in September and October, which sounds good on the surface, right? Wrong. In this twisted market logic, good news is bad news and bad news is good news. But here is the nuance. The market is interpreting this data as a sign that the economy is still volatile enough to warrant Fed intervention. The confusion in the labor market data just adds to the uncertainty, and uncertainty drives people into safe haven assets. When nobody knows what the truth is, you buy the asset that has been truth for 5,000 years. Let's talk about the Federal Reserve meeting coming up. The market has priced in a near certainty of a 25 basis point cut. But here is the trap. If they cut rates while inflation is still sticky, they are essentially pouring gasoline on a bonfire. Real interest rates, that is, rates minus inflation, will go even deeper into negative territory. Negative real rates are the best possible environment for gold and silver. You are literally being paid to borrow money and penalized for saving cash. In that environment, holding zero-yielding metal is the only rational move to preserve your purchasing power. However, we must remain vigilant and not get drunk on the green candles on the chart. Goldman Sachs came out in October warning that silver would experience more volatility and downside risk. Now, I usually bet against whatever Goldman says, because they are often trying to shake retail investors out of their positions so they can buy in cheaper. But in this case, the volatility is real. Silver is a wild beast. It can drop $2 just as fast as it rose $2. You have to have a stomach of steel to ride this bull. If the Fed comes out hawkish, meaning they sound tough on inflation and hint that cuts might be delayed, we could see a sharp pullback. The algorithms that trade these markets react in microseconds to keywords from Jerome Powell. If he sneezes the wrong way, the computers will dump silver contracts. You need to be prepared for that. This is why I always tell you, do not trade with leverage. If you own the physical metal, a dip in the paper price means nothing to you. In fact, it is a gift. It is an opportunity to back up the truck and load up on more. The consolidation is a term you need to get comfortable with. After a parabolic move like we saw today, 4.5% in one session, it is healthy for the market to take a breather. It needs to digest these gains. We might see silver trade sideways or dip back down to test support levels. Do not panic. This is normal market mechanics. The weak hands who bought at the top because of FOMO will get shaken out, and the smart money will step in to establish a higher floor. This is how a sustainable bull market is built, step by step, not a straight line to the moon. Let's discuss the behavior of the coin shops and bullion dealers, because that is where the rubber meets the road. My sources are telling me that while there is buying, there is also a lot of selling back to dealers. People are taking profits. Dealers are paying 5% back of spot for some items. This is interesting. It tells me the public is still skeptical. They are treating silver like a trade, not a lifestyle. They are happy to cash out for a few extra fiat dollars to buy Christmas gifts. This sentiment suggests we haven't reached the mania phase yet where there is no physical metal left to buy. The fact that people are selling into this rally is actually bullish in a contrarian way. It means there is still a wall of worry. Bull markets die on euphoria, not skepticism. As long as people are doubting the rally and selling their stacks, the market can climb higher. It is when everyone and their grandmother is lined up around the block to buy silver at any price that I will start to get worried. We are not there yet. We are in the phase of disbelief where the price rises and people say it can't possibly go higher. Guess what? It can, and it likely will. We also have to consider the geopolitical angle, which the input data touches on lightly but is crucial. The world is fracturing into two blocks, the West and the BRICS nations. The BRICS are accumulating gold and silver at a record pace because they want to bypass the US dollar. Every ounce of silver that goes into a vault in Shanghai or Mumbai is an ounce that is effectively removed from the Western financial system. This geopolitical tension creates a permanent bid under precious metals. It is a flight to safety in a world that is becoming increasingly dangerous and unpredictable. Let's look at the mining stocks for a moment. The article mentions that mining companies are tracking well, but often they lag the physical price. This is another opportunity. If silver stays above $60, these miners are going to be printing cash. Their margins expand massively with every dollar increase in the spot price. But remember, mining is a difficult business. Input costs like diesel and labor are rising too due to inflation. This is why I prefer the physical metal. It has no counterparty risk, no management risk, and no energy cost risk once you hold it in your hand. I want to circle back to the dollar weakness. A drop of 8% this year is significant, but the dollar is still relatively strong compared to other fiat currencies like the yen or the euro. This is the cleanest shirt in the dirty laundry theory. But silver doesn't care which fiat currency is the least terrible. Silver is measuring the collapse of the entire fiat system. Whether you measure silver in dollars, euros, or yen, it is breaking out. This is a global phenomenon, not just a US story. The whole world is waking up to the debasement of paper money. The shaking out of the shorts is a beautiful thing to watch. For years, the bullion banks have shorted silver to keep the price down. But when the price moves this violently, they get margin calls. They are forced to cover their shorts by buying long contracts, which drives the price up even further. This is called a short squeeze. We saw a glimpse of it today. If the price holds above 60, we could see a cascade of short covering that sends silver to $70 or $80 faster than anyone expects. The hunters are becoming the hunted. However, we must address the liquidity trap. The input mentioned that during the COMEX outage and the London squeeze, liquidity disappeared. This is the danger of electronic markets. When things get real, the screens go dark. You cannot rely on an ETF or a futures contract to save you in a crisis. If the system locks up, you are just an unsecured creditor. This is why the distinction between paper silver and physical silver is the most important concept you can learn. If you can't hold it, you don't own it. It is that simple. The psychology of the $60 price point is critical. Humans like round numbers. Breaking 60 is a signal to the algorithmic traders and the retail public alike. It opens the door to the all-time inflation-adjusted highs. If you adjust the 1980 high for inflation, silver should be well over $100. We are still cheap in real terms. That is the incredible part. Despite doubling this year, silver is still 50% below its inflation-adjusted high. The upside potential is staggering compared to the downside risk. Let's talk about the Fed pivot that everyone is obsessing over. The market thinks the Fed is going to cut rates to save the economy. But what if they are cutting rates to save the government? With $34 trillion in debt, the Treasury cannot afford 5% interest rates. The Fed is being forced to monetize the debt. This is yield curve control by another name. They are sacrificing the dollar to save the bond market. And when they sacrifice the dollar, they are essentially handing a gift to every gold and silver holder on the planet. I want to warn you about the bull traps. In the coming days, you might see sharp sell-offs designed to scare you. The banks know how to paint the tape. They will trigger sell stops below key levels to flush out the leverage. Do not fall for it. This is a war of attrition. They have the algorithms, but we have the physical metal. They can print paper contracts, but they cannot print ounces. As long as we hold the physical, we control the float. The power is shifting back to the individual, provided you have the discipline to hold through the volatility. The role of China cannot be overstated. With their inventories low, they are going to be aggressive buyers in the global market. They are not price sensitive like Western investors. They buy for strategic reserves. If China decides to restock its silver reserves to prepare for a conflict or a trade war, they could drain the COMEX dry in a month. We are competing with sovereign nations for a finite resource. You are not just trading against hedge funds, you are trading against Beijing. And right now, Beijing is winning the accumulation game. Let's re-examine the warnings from Harrius and other refiners about silver being high beta. They are correct, but that is a feature, not a bug. You buy silver because it is volatile. You want that explosive upside. If you want safety, buy T-bills and lose 3% a year to inflation. If you want wealth generation, you buy silver and accept the roller coaster. The volatility is the price of admission for the massive gains we are seeing. Do not let the volatility shake you out of the best performing asset of the year. The timeline here is crucial. We are heading into the end of the year. Volumes are often lower, which means moves can be exaggerated. But it also means that the window dressing is happening. Fund managers want to show they own the winners at the end of the year. Since silver is a massive winner, we might see institutional buying just to get it on the books before December 31st. This could provide a tailwind into the new year. We are setting up for a very powerful January effect if this momentum sustains itself. Now what happens tomorrow? We are waiting on Jerome Powell. If he comes out and tries to talk the market down, we could see a knee-jerk reaction lower. But the market has stopped listening to the Fed's bark. The market is looking at the Treasury's balance sheet and the deficit spending. The fiscal dominance has taken over. It doesn't matter what Powell says. The government is spending money like a drunken sailor, and that money has to come from somewhere. It comes from dilution of the currency supply, which leads directly to higher silver prices. I want to touch on the exit strategy. Many of you ask, when do I sell? My answer is, you don't sell silver for dollars. You sell silver for assets. You swap your silver for land, for a business, for a home. You do not trade a hard asset back into a melting ice cube of fiat currency unless you have an immediate need. The goal is financial sovereignty. Silver is your bridge to get from the crumbling old system to whatever the new system looks like. Do not burn that bridge for a quick 5% profit. The local coin shop report I mentioned, paying 5% back of spot, is a localized phenomenon. In other parts of the country, premiums are still high. This shows the market is fragmented. But the general trend is clear. Supply is tight, demand is rising, and the price is reacting. If you have the opportunity to buy from a private party or a dealer who is flush with inventory, take it. Do not wait for the perfect bottoms. In a bull market, you buy the dips, you buy the rips, and you sit on your hands. Let's look at the correlation between silver and the broader stock market. Usually when stocks crash, silver sells off initially as people rush to raise cash. We might see that scenario if the recession hits hard. But silver recovers much faster. In 2008, silver crashed and then rallied massively. In 2020, same thing. If the stock market rolls over, use the initial panic sell-off in silver as your final buying opportunity. That is the blood in the streets moment. Be ready with dry powders. We are also seeing a change in the narrative regarding green energy. The Green New Deal, regardless of your politics, is a massive consumer of silver. Solar panels are not optional for these government mandates. They require millions of ounces. This demand is inelastic. They will pay $60, $80, or $100 an ounce because they have to. The government mandates are effectively guaranteeing a bid for silver for the next decade. You are front-running the government's own policy by owning the metal they desperately need. So what is the takeaway from this historic day? The $60 barrier has fallen. The psychological shackles are off. Silver has proven it can run independently of gold and outperform it significantly. The fundamentals, supply deficits, industrial demand, monetary debasement, are all aligning perfectly. The technicals are breaking out. The macro environment is screaming for hard assets. The stars have aligned in a way I haven't seen in 20 years. But remember, the ride will be bumpy. They will try to buck you off. They will slam the price on Sunday nights when volume is low. They will release bearish reports. They will tell you gold is a barbarous relic, and silver is just an industrial commodity. Ignore the noise. Look at the debt clock. Look at the deficit. Look at the printing press. That is your North Star. As long as they are printing, you should be stacking. If you are sitting on a stack of silver today, congratulations. You are your own central bank. You have insurance against the madness of politicians and bankers. But do not get complacent. Continue to educate yourself. Watch the Fed meeting tomorrow not with fear, but with the analytical eye of a strategist. Understand that every word they say is designed to manipulate psychology, not to tell you the truth. The truth is in your hand, heavy and cold. We are entering the endgame for the current fiat cycle. It might take another year or another 5 years, but the math is deterministic. They cannot pay the debts. They must inflate it away. In that world, silver is not just an investment, it is a lifeboat. Today, the lifeboat just got a little more expensive for the latecomers, but there is still room for those who act decisively. Let me know what you think. Are you buying this breakout, or are you selling into the strength like the customers at the local coin shop? Do you trust the Fed to engineer a soft landing, or are you preparing for the crash? Put your thoughts in the comments. This is a battle for our financial future, and we are in this together. Stay disciplined, stay skeptical, and keep stacking. I'm the Iron Bull, and I'll see you on the next update.